As expected, the Fed cut rates by 25 basis points yesterday, but Treasury yields jumping after this comment from Fed Chair Powell. Listen.
In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course.
Joining us right now with his insights is Roger Ferguson, former Fed vice chair, as well as a CNBC contributor. You listened to those words, and you thought what? Maybe is the very just basic way to ask the question.
I thought a couple of things. One is highly unusual for him to be so clear about the next meeting. Normally they're a little more circumspect, but he was very much clear at pushing back. Secondly, I thought not a total surprise. I think markets had forgotten the September dot plots that showed, roughly an evenly split committee. And after the meeting, a number of the Fed presidents, particularly President Schmidt and a few others, had expressed some disagreement or some concern. So, I think the market, had they really been listening, would not have been as surprised. But to be fair, it is highly unusual for a chair to be so explicit about the uncertainty in the December meeting. And they clearly try to take it off the table as much as possible.
But speak to that, though. What do you think was going on? Because you're right, there was a sort of almost clarity about the lack of clarity. And he seemed to almost lean into the idea that there was this dissension and debate taking place. And that's something typically that I felt that he has veered away from trying to acknowledge when there has been that kind of dissent.
There are a couple of things going on. One, it's important just to say the obvious, right? He had two dissenting votes this time, one for even further cuts, one for no cut whatsoever. So obviously, add that to the September dot plots, and at some point you just have to sort of tell the truth. There is dissension. Secondly, I think they want more optionality around December. I think almost everybody is probably somewhat uncomfortable that the markets seem to be so much ahead of the Fed, had seemed to expect not just a cut in December, but a couple more next year. And I think he went a long way to say things like the so-called neutral rate is probably roughly where we are now. He really wanted to be much more balanced in talking about inflation risk as well as a weakening labor market. And I think all of that at the end of the day is to get the Fed control of the outcome as opposed to the markets driving the outcome.
Hey, Roger, how much of a concern do you have about stagflation at this point? It's not a clear stagflationary market, but there are certainly whiffs of it if you're looking at the job market weakening, but also inflation being stuck at around 3% year over year. That may be why you're seeing a split where, you've got people saying you shouldn't go anywhere and people saying you should cut 50 basis points. That's a weird time to try and navigate.
Well, first, I think I share, and I think I've shared on this show, a concern about stagflation as a potential outcome. I describe it as mild stagflation. Beck, you may recall that a little while ago I came on and talked about a CEO survey where the CEOs were also mainly focused on a stagflationary outcome. And you're absolutely right, and I think Chair Powell was clear about it. There are no riskless choices now. Inflation is however you measure it, well above the 2% target. The labor market is weakening. There's a mystery about the labor market that we should be clear. How much of it is supply and how much of it is demand? And this time, Chair Powell leaned a little bit more into the supply story. And the implication of that is if you think the problem with the labor market is labor force participation declining, immigration reducing dramatically, there's not much that monetary policy can do about that. And then you add to it just the general uncertainty. So I think they're right to be cautious. And yes, I am in the camp that says the mild stagflation risk seems like more likely than not outcome as of today.
Roger, in terms of the tools that you think this Fed can impose as it relates to employment or unemployment in this country, we continue to read stories about big tech companies and others laying off folks or at least having plans not to hire more, et cetera, et cetera. Historically, you'd say, OK, if we let up a little bit, maybe corporations would spend a little bit more and, the employment picture would improve. It's not so clear to me if you believe that some of that some of those layoffs are imposed, if you will, by AI, what role and what tools the Fed has to goose those numbers in any which way? What do you think?
You're absolutely, and I think Chair Powell mentioned that a little bit yesterday. There are a couple of things that he said that lean in that direction. One is exactly the point that you made. Secondly, he talked about how blunt this tool is, and it doesn't help particular classes of unemployed people. There's a question that came up from one of the reporters. And then finally, back to the point I just made, if the slowdown in the labor force is due primarily to supply, and we have this low layoff, or maybe now rising layoff, but low demand market, the Fed may be stuck. And that's why stagflation risks are the worst possible for them. And he was very explicit about it. And indeed, he observed the information notices, the announcements about layoffs, but said at this stage, at least, it's not really showing up in the aggregate data. So I think he nodded in all the directions that were appropriate, some that you've talked about. But you hit the main point, which is they are, by their own admission, in a very difficult position, one that no central bank likes. And it is, as he's observed, showing the dissensions in the ranks as people assess different outcomes and as they have different tolerances for inflation above target or unemployment that's too high.
Roger, well, let me throw one last thing at you, which is, we have a number of guests who've come on, I would say, in the last month that talk about an AI bubble. They talk about a sort of a level of almost indiscriminate spending in the artificial intelligence space. If you were the Federal Reserve and you thought to yourself, this feels like it's getting a little bit out of control, I'd like to tamp that down. I don't want that to get, I want to encourage investment, but I want it to be disciplined. What would you do?
Look, their tool is very rough. He said something yesterday that is very important, which is 25 or 50 basis points is not what's driving this massive building of data centers. It's being driven by expectations of great returns, inability to keep up with demand. So I don't think they are in a position to actually attempt to tamp down this capital expenditure any more than they could tamp down the equity markets very successfully. So I think the most you can do is observe it, talk about it, and then see if it shows up in some way in the macro data. So again, I think they are hamstrung a bit in dealing with a major issue that some may see out there.